Hello everyone and welcome back for another video. Hope you're all good. So today we've got a pretty packed video, so make sure you stay locked in for the whole video. And then towards the end, we will have a look at the Bitcoin and Ethereum market analysis, where it's at, what to expect, and so on. Yesterday, something very interesting happened. Prices moved up, but if you look closely, the move didn't look like a healthy rally. It looked more like liquidity being pulled into the market before something bigger. And the timing is not random. Right now, markets are entering one of the most important macro weeks in months. Within a very short period of time, we're getting three key economic reports from the United States, data that Federal Reserve literally uses to decide the direction of interest rates. At the same time, the US Treasury has quietly started buying back billions of dollars of its own bonds, which could inject fresh liquidity into the system. And when liquidity starts moving, crypto is usually one of the first markets to react. So in this video, we're going to break down why this macro week could create huge volatility, why the Treasury's bond buybacks are suddenly being discussed everywhere, and the exact levels I am watching for Bitcoin and Ethereum today, because the current price move might not be what it seems. This week is packed with macroeconomic data that can shift expectations about interest rates, and when that happens, markets across the board react, from stocks to crypto. The first major indicator is the GDP, Gross Domestic Product. GDP measures how fast the US economy is growing. In simple terms, it shows how actively the economy is producing goods and services. If GDP comes in stronger than expected, it signals that the economy is running hot. That might sound positive, but for markets, it can create a problem. A strong economy can mean inflation pressure stays elevated, which increases the probability that the Federal Reserve keeps interest rates higher for longer. And higher rates usually pressure risk assets like stocks and cryptocurrencies. If GDP comes in weaker than expected, it may signal that the economy is slowing down. In that case, markets may start pricing in future interest rate cuts, which tends to support risk assets. The second key report is PCE, Personal Consumption Expenditures. This is usually the Federal Reserve's preferred inflation indicator. Most people focus on CPI, but policymakers often rely on PCE because it better reflects the changes in consumer behavior and spending patterns. If PCE inflation is higher than expected, it suggests inflation remains stubborn. That will increase the chances that the Fed keeps policy tighter for longer, which generally puts pressure on markets. But if PCE shows inflation cooling, markets usually interpret that as a positive because it increases the probability of a more dovish policy stance for the Federal Reserve. And the third major indicator is the unemployment data, which reflects the condition of the labor market. The labor market is one of the key pillars of the US economy. If employment remains low, it suggests the economy is still strong. But there's another side to this. A strong labor market can also fuel inflation. Rising employment often comes with higher wages. However, if employment starts rising, it may signal that the economy is cooling, which could increase the probability of future stimulus or rates cuts. Together, these three reports create a very clear macro picture. GDP shows the strength of the economy, PCE shows the level of inflation, unemployment shows the health of the labor market. And these are exactly the indicators that the Federal Reserve studies when making interest rate decisions. That's why markets often become extremely volatile when these reports are released together. So currently, looking on Forex Factory, we can see that for Thursday at 2:30 p.m., we have news coming out about unemployment rates. So we have one at 2:30 on Thursday, which is tomorrow, and then we have another one on Friday, which is at the same time, unemployment change, unemployment rate. But there's another development that traders are paying attention to right now. Recently, a document from the US Treasury began circulating online showing a schedule of Treasury buyback operations. In simple terms, the government has started repurchasing its own bonds from the market. These operations are listed under liquidity support and cash management. Some of the buybacks have limits of around $4 billion, while one recent entry showed a cap of $15 billion. So why does this matter for the markets? Because when a Treasury buys back bonds, investors who sell those bonds receive cash in return. And that means capital was previously sitting in government debt suddenly becomes liquid again. That liquidity often gets reallocated across markets, including equities, commodities, and crypto. In other words, this acts like a soft liquidity injection into the financial system. And crypto is one of the most liquidity sensitive markets in the world. However, it's important to remember that for now, the total amount involved is still relatively small. So it may not yet be enough to support a full market rally, which is why caution is necessary in the short term. So as you can see, the announcement date was the 9th, which is 2 days ago, and the operation date was yesterday. So the 10th, timing between 1:40 and 2 p.m. Settlement date is today. Cash management, that's the operation type. Security type and maturity range, 1 month to 2 years. Maturity date range, and that's obviously the 2 years in this box. Minimum purchase amount, 0. And then the maximum purchase amount was a 15 billion that we just talked about. And as of for the market structure today, looking at the current price structure, the plan for today still leans toward a continuation of the downward move. On the daily time frame, a significant upper shadow has formed. This kind of structure often acts as a strong resistance, preventing price from continuing higher. Another factor worth noting is the weakness in Ethereum, which closed below the previous day's high, suggesting buyers may be losing momentum. And now finally, let's start with Bitcoin. During the current trading session, a local decoupling of the lows has formed. This sometimes creates the conditions for a short-term bounce towards higher liquidity levels. If that happens, the key level to watch is around 70,300. If price reaches that zone, it may begin forming reversal structures that could trigger the next move down. In that case, the next potential downside target would be 68,000. So the main idea is first, a possible liquidity move towards 70,300, then a potential reversal toward 68,300. So on the screen, we have this level marked as being the $70,300 range. And as of at this level, we have the $68,300 range. So as you can see, the price could obviously hit that level, but then we could see the reversal in that price going back down to the $68,300 range. And looking at Ethereum currently appears weaker than Bitcoin, which is important to note. Similar to Bitcoin, a local bounce is still possible. If liquidity gets targeted above current levels, Ethereum could move toward the $2,040 range. However, if a reversal structure forms there, the next downside target sits around 1,990. So the idea is pretty much the same as Bitcoin. Potential move up towards that price, and as of for Ethereum being the $2,040 range, followed by a possible move down towards 1,990. So we have both of those levels marked here. So we have the $1,990 range, and then we have the $2,040 range. So as you can see currently, and finally today, we also have the CPI inflation release, which could become the main volatility trigger for the market. Expectations are already high, and whenever expectations are elevated, surprises can cause very sharp moves. So today's CPI data could play a major role in determining the next direction of the market. So right now we have a rare combination: major macroeconomic data releases, Treasury liquidation operations, and important technical levels in crypto all happening at the same time. And when those factors align, markets often produce their biggest moves. So stay cautious, watch how prices react to liquidity levels, and pay attention to the macro data. And as always, if you found this analysis useful, don't forget to subscribe so you don't miss the next market breakdown. Drop a like, and I'll see you in the next one.